All right, Fintech homies. You know we like to go deep on the stuff that really matters. And you wanted to unpack a classic. So today, we're diving into The Intelligent Investor by Benjamin Graham.
This book is like the OG guide,
hmm
to making smart money moves.
Exactly. And it's not just about, like, picking stocks. It's really about mindset, patience, and not getting, like, swept up in all the hype. Something I think we can all struggle with, right?
Absolutely. What's fascinating about The Intelligent Investor is that even though Graham wrote it decades ago, it's still incredibly relevant, especially in the age of fintech.
So true. Okay, so for this deep dive, we've got excerpts from the book itself and some commentary from Jason Zweig, who adds a modern lens to Graham's ideas.
Zweig's insights are great.
Yeah, let's start with something that really jumped out at me. The definition of an intelligent investor. It's not about being a math whiz, right?
Right. Zweig emphasizes that for Graham. It was more about character than like pure brain power.
Okay, interesting.
Think patience, discipline, constantly learning, controlling your emotions, and thinking for yourself.
Those are some powerful traits.
Yeah, and qualities that any fintech homie looking to level up their game should be cultivating.
Absolutely. Love that.
Yeah.
Takes the pressure off needing some, like, genius level IQ to be a successful investor.
Yeah.
But this idea of separating investment from speculation, that's where Graham gets real.
Oh, he does. For Graham, investment is about thorough analysis, aiming for both safety of principal and a decent return.
Makes sense.
Speculation, on the other hand, is hoping for quick price jumps. And as we've all seen, with some of those high-flying tech IPOs, that can lead to disaster.
Oh, yeah. Definitely seen that happen.
Growth doesn't always equal profit, especially not for the average investor who might be getting in at the wrong time.
Ouch, yeah. Remember that painful lesson from our deep dive on those early SPACs? But how does the intelligent investor avoid those traps? What's the secret sauce Graham's serving up?
One of the most powerful tools Graham gives us is the concept of Mr. Market.
Okay, Mr. Mark.
Imagine this. Mr. Market shows up at your door every single day wanting to do business.
Okay, so Mr. Market is our new BFF, always bringing us deals.
Not quite. Think of him more like that one friend who's always got a can't-miss scheme.
I know that guy.
Right. Sometimes he's euphoric, offering you crazy prices for your stocks. Other times, he's down in the dumps, practically begging you to sell low.
So the intelligent investor learns to recognize when Mr. Market is, like, manic, when he's depressive, and not let his, wild mood swings dictate their moves.
Exactly. You see this all the time, even in the fintech world.
Oh, for sure.
Think about the crypto craze a few years ago. Pure Mr. Market on a sugar rush.
I remember those days.
Or those fear-driven sell-offs that happen when there's some big regulatory news. It's all emotion driving the market in the short term.
So Mr. Market is basically our emotional side personified.
Yeah.
But Graham was also wary of what he called obvious growth industries, right? Didn't he see that as a trap even back then?
He did. And it's even more relevant today. I mean, everyone piles into what seems like the next sure thing, right? But then reality has a way of hitting back.
It always does.
Remember those meme stocks, fintech homies?
Oh, how could we forget?
Past performance is never a guarantee of future results. And if everyone's already betting on the same horse, the odds might not be in your favor.
True, true. So how do we, as intelligent investors, separate the signal from the noise? What should we be looking for?
Graham emphasizes the importance of financial strength, and it goes beyond just looking at a company's earnings or how, quote-unquote, disruptive their tech is.
So we're talking about, like, really getting into the nitty-gritty of their balance sheet.
You got it. How much debt are they carrying? What's their working capital like? Basically, a measure of their short-term financial health.
Okay, yeah, that makes sense.
You want companies that can weather the storms, not the ones that are over-leveraged and could crumble when things get tough.
So even in the fast-paced world of fintech, where it seems like everyone's chasing the next unicorn, Graham's saying, slow down, check the financials, make sure they've got a solid foundation.
Precisely. It's like building a house. You wouldn't start with the roof, right?
Definitely not.
You need a strong foundation, and that's what Graham's emphasizing here.
Makes sense.
And that's like a point that's often overlooked, in the rush to get in on the next big thing. Flashy app, buzzworthy concept, doesn't necessarily mean they're financially stable.
So true. Speaking of getting caught up in the hype, I'm remembering that episode we did on, like, market psychology and how FOMO can lead to some really bad decisions. Mr. Market is basically like the ultimate FOMO, right?
Absolutely. He's that voice whispering in your ear, everyone else is making money, you're missing out. But the intelligent investor recognizes that voice, takes a step back, and makes decisions based on logic, not emotion.
Okay, so we've got our FOMO in check. We're like digging into the financials, making sure these companies are built to last.
Hmm.
But even with all that, markets can be so unpredictable. How did Graham approach, like, managing risk in a world that's constantly throwing curveballs?
One of his core principles is the margin of safety.
Okay, margin of safety.
It's the idea that you should never pay full price for a stock, even if it's a company you absolutely believe in.
Right.
You always want to buy with a discount.
A discount.
Yeah, buffer. To account for those unforeseen events, market dips, you know?
Right.
Those times when Mr. Market gets a little too pessimistic.
I see. So it's like having a financial cushion,
Uh-huh.
a way to protect yourself from the downside. But how do you actually calculate that margin of safety? Is it like a specific formula or more of
Yeah.
a gut feeling?
It's a bit of both, honestly. Graham provided some specific metrics to look at, like the price to earnings ratio, the price to book ratio, things we can easily find on any financial website these days.
Right.
But it's also about understanding, like, the qualitative aspects of the business, the quality of management, the competitive landscape, their long-term growth potential.
So it's not just about like crunching numbers. It's about understanding the story behind those numbers and
Yeah.
using that to figure out how much of a discount you're comfortable with.
Exactly. And that margin of safety can vary depending on your risk tolerance and your investment goals. Like a more conservative investor, someone focused on preserving capital, might require a larger margin of safety than someone who's more comfortable taking on risk.
Makes sense. It's like customizing your investment strategy to fit your own like financial personality.
Now, speaking of strategies, Graham talked about different approaches for different types of investors, the defensive investor and the enterprising investor.
He did. And this is where things get really interesting, especially for, fintech homies
Right.
who are often looking for those opportunities to outperform the market.
Yeah, for sure. Okay, let's break it down. Who is this defensive investor?
The defensive investor is someone who really prioritizes safety and stability.
Okay.
They're not looking to spend hours, you know, poring over financial statements or chasing the latest trends. They want a portfolio that's built to weather any storm, and they're willing to accept lower returns in exchange for that peace of mind. Sounds like a good strategy for someone who's just starting out. Or maybe someone who's getting close to retirement and wants to protect their nest egg.
Absolutely. For the defensive investor, Graham recommended a diversified portfolio, focusing on high-quality bonds and blue-chip stocks. Companies with a proven track record of profitability and stability.
So the classic set it and forget it approach.
Yeah.
But what about those of us who are a little more, enterprising?
Well, for the enterprising investor, Graham recommended a more active approach.
More active.
Yeah, one that involves deeper research, a willingness to really dig for those hidden gems that the market might be overlooking.
So this is where those like deep dive research skills really come into play. We're talking rolling up our sleeves, getting into the weeds of financial statements, industry reports, all that good stuff.
Exactly. The enterprising investor is looking for those opportunities to generate higher returns. But they still have that focus on value and that margin of safety we talked about. They're not afraid to venture into less charted territory, maybe explore smaller companies, emerging markets, or even, the world of crypto.
Bringing Graham's principles into the crypto market, that's a whole other deep dive right there. But it speaks to how timeless his wisdom really is. It's a framework you can apply across different asset classes, different industries, different market cycles.
It is. That's what makes the intelligent investor such a valuable resource, even for, fintech homies who are navigating this rapidly evolving world of finance. It's about the underlying principles, the mindset, the approach to risk management.
Speaking of risk management, one of the things that stood out to me was Graham's emphasis on dividends. He wasn't just chasing growth. He was looking for companies that were returning profits to their shareholders.
Absolutely. And in the world of high growth tech companies, where profitability often feels like a distant goal, that focus on dividends can seem almost, I don't know, old fashioned.
Right.
But Graham saw it as a sign of financial strength, a commitment to rewarding shareholders, and a way to generate income, even when the market is being volatile.
It's like having a steady stream of cash flow coming in, regardless of what Mr. Market is doing that day.
Precisely. And it aligns with that whole idea of building a portfolio for the long term, not just for the next quarter's earnings report.
Yeah, focusing on the long game. And speaking of the long term, one of the most powerful concepts from the intelligent investor has to be the idea of compounding, right?
Absolutely. The eighth wonder of the world, as they say. And it's something that Graham really understood. It's the idea that, consistent long-term investing can create this snowball effect, with your returns generating more returns and those returns generating even more returns.
I love that analogy. It's like a snowball rolling downhill, getting bigger and bigger.
Yeah.
But for that snowball to really gain momentum, you need time.
Exactly. The longer your time horizon, the more opportunity you have to ride out those inevitable market dips and let the power of compounding work its magic.
So it's another reminder that investing isn't about getting rich quick. It's about building wealth sustainably over time and avoiding those emotional decisions that can, totally derail your progress.
Absolutely. And that brings us back to the importance of emotional discipline, one of those core traits of the intelligent investor that we talked about earlier.
It's like Graham is saying, yes, the market will fluctuate, there will be ups and downs, but if you have a solid plan, if you've done your research, if you're investing in companies that are built to last, then you can ride out those storms and come out stronger on the other side.
Precisely. And that's a message that resonates just as strongly today in the age of fintech as it did back when Graham was writing.
So true. It's a reminder that even though the tools and technologies we have evolved, dramatically, those fundamental principles of, sound investing remain timeless.
They do. And one of those principles that I think is especially relevant for fintech homies is this need for constant learning. Graham was a voracious reader, and he believed that investors should always be striving to expand their knowledge and understanding of the markets.
So reading The Intelligent Investor is just the beginning. It's about, cultivating that lifelong curiosity, staying up to date on market trends, understanding how new technologies are impacting the investment landscape.
Exactly. And with the pace of innovation in the fintech space, that commitment to continuous learning is more important than ever.
So we've covered a lot of ground here, from the difference between investing and speculating, to the importance of financial strength, dividends, that margin of safety, and that all-important long-term perspective. But there's one more key takeaway from The Intelligent Investor. That, I think, is especially relevant for our fintech homies. And it's the idea of minimizing trading fees.
Ah, yes. That's a crucial point. Graham understood that those seemingly small fees can really eat into your returns over time, especially if you're, a frequent trader.
And in the world of online brokerages and robo-advisors, where trades can happen, instantly, it's easy to forget about those costs.
It is. But Graham would remind us that every dollar we save in fees is a dollar that can be put to work compounding for us, helping us achieve our financial goals faster.
So it's not just about picking the right stocks or timing the market perfectly. It's also about being mindful of those costs. That can chip away at our returns over time.
Absolutely. And it's a reminder that becoming a successful investor isn't just about mastering the, technical aspects. It's also about adopting the right mindset, cultivating the right habits, and making decisions that align with our long-term goals.
It's about becoming that intelligent investor that Graham envisioned. Someone who's not just chasing the next hot stock tip, but is building a portfolio for a lifetime of financial success.
Yeah, it really is about playing that long game and tuning out all that noise that can distract us. One of the things I found refreshing about The Intelligent Investor was that it wasn't about trying to, predict the market or time those perfect entries and exits. Right. Graham believed that trying to, outsmart the market is a fool's errand.
Totally.
He advocated for a more disciplined approach, one based on value, patience, and a long-term perspective.
So it's about recognizing that we can't control what the market does,
Yeah.
but we can control, our own actions and reactions.
Exactly. And that's powerful,
Yeah.
especially in the world of fintech, where there's so much emphasis on, speed and agility.
It's like a reminder to slow down, take a breath, make decisions that are aligned with our long-term goals.
Oh,
It's not
no.
just our, short-term impulses.
Absolutely. And that brings us back to one of Graham's core principles, the importance of emotional discipline.
Yeah, that ability to stay calm and rational when everyone else is, panicking. Or to resist the urge to chase the latest hot stock tip when it seems like everyone else is getting rich.
Exactly. And that emotional discipline, it's something you can cultivate over time through experience, education, and a commitment to sticking to your plan.
It's like building a muscle, right? The more you use it, the stronger it gets.
Precisely. And that's why The Intelligent Investor is so valuable. It's not just a book about investing. It's a book about building the right mindset, developing the right habits, and cultivating that emotional discipline that's essential for long-term success.
So it's really as much about psychology as it is about finance.
It is. And that's a message that's just as relevant today as it was back then.
So for all you fintech homies out there looking to level up your investment game, The Intelligent Investor is a must-read. It's a timeless classic.
It really is.
It gives you a framework for thinking about investing in a way that's both rational and profitable.
And it's a reminder that the principles of sound investing, they never go out of style, no matter how much the world of finance changes.
So true. Well, I think we've covered a lot of ground today. Hopefully our deep dive into The Intelligent Investor has given you some valuable insights, fintech homies.
I hope so too. And I encourage everyone to pick up a copy of the book and continue exploring Graham's wisdom on your own.
Absolutely. It's a book you can come back to again and again, and each time you'll probably discover something new.
And remember, the journey to financial success starts with a single step.
So keep those brains engaged, fintech homies,
Yeah.
and keep on learning. If you enjoyed our deep dive today, don't forget to hit that like button and subscribe to the channel for more thought-provoking content.
Until next time, happy investing.